All right, today we are getting our hands dirty and digging into an absolute titan of industry, Caterpillar. You probably know it as CAT. These are the guys whose massive yellow machines literally build our world. But the big question is, does that make its stock a solid foundation for your portfolio? Let's dive in and find out.
And that really gets us to the heart of it all today. I mean, with its stock price hitting some pretty impressive highs, we have to stop and ask, is this industrial icon actually overvalued? That is the central puzzle we are going to try and solve together right now.
So here's our game plan. First, we're going to get to know the business. Then we'll try to crack the value code and see what it's really worth. After that, we'll weigh its competitive strengths against the risks, look at some future scenarios and price targets, and then we'll wrap it all up with the final verdict. Sound good? Let's get to it. Okay, first up, Section 1, Caterpillar, the global giant. Look, before we can even begin to talk about numbers and valuation, we gotta understand what makes this company tick. So what exactly is Caterpillar? Well, it's the world's #1 maker of construction and mining gear, plus all sorts of engines and turbines. But here's the thing, it's not just about selling those big new machines. A huge piece of their business, and a very profitable one, is the aftermarket. We're talking parts and services, which gives them that nice recurring revenue. And the real key to their kingdom, their massive global dealer network. Now, the thing you have to remember is that this is a deeply cyclical business. Its success is directly tied to how the global economy is doing, how much is being spent on infrastructure, and where commodity prices are. All right, let's move into Section 2 and see where this is going, cracking the value code. This is where things get interesting because we're going to compare what the market thinks, the stock price, with a hard look at the company's actual underlying worth. And whoa, right out of the gate, we see a huge disconnect. The market price is floating around $717, but the calculated intrinsic value, which is basically an estimate of what the company's really worth based on the cash it's expected to generate in the future, is way down in the $480 to $520 range. That is a massive premium the market is paying right now, and honestly, this gap is what our whole analysis really hinges on. Now, let's pop the hood and look at the engine here with these financial checks. You can see it's a bit of a mixed bag. And frankly, there are a lot of not good verdicts that kind of make you pause. Take a look at the debt-to-equity ratio. Over 2. That's pretty high, especially for a business that goes through big ups and downs. And see this? The 5-year cash flow growth is flagged as weak, and that's a huge deal for a company's long-term health. Even its valuation metrics are flashing red. Now, its return on invested capital is good, no doubt, but the overall picture? It suggests that while the company's making money, its financial foundation might have a few cracks. And that leads us perfectly into Section 3, the moat versus the risks. Any great company needs a moat, a durable, competitive advantage to protect its castle. But hey, every castle has its weak spots, right? And believe me, Caterpillar's moat is wide and it is deep. Its global scale is just enormous. The brand name itself basically means durability. But the real secret weapon, the thing that's almost impossible to copy, is that dealer network. It is a massive barrier to entry. I mean, competitors just can't replicate this global web of sales, service, and support, and that creates super high switching costs for customers who are already locked into that ecosystem. But on the other side of that moat, we've got some red flags waving. We've touched on a few already, like that declining cash flow growth and the sky-high valuation. But let's really focus on that leverage for a second. A debt-to-equity ratio of over 200%, that is a serious weight to carry for a company whose profits can swing wildly with the economy. Think about it. When a downturn inevitably hits, that huge pile of debt gets a whole lot heavier. So, when you put it all together, how does it balance out? This weighted SWOT analysis kind of gives us the big picture. You can see the strengths score really high, an 8, but the weaknesses and threats also carry a lot of weight. So the final score comes out to a 6.8 out of 10. And what does that mean? Well, it means Caterpillar is a solid, high-quality company, for sure, but it's also facing some very real challenges that you just can't ignore. Okay, on to Section 4, scenarios and price targets. This is where we get super practical and ask the question everybody wants to know, what's a good price to actually buy this stock? So if we look to the future, the company's value isn't just one single number. It really depends on what happens next. In a bear case, maybe a recession hits, the value could drop all the way to $400. The base case, kind of the most likely scenario, sits around $500. But here's the kicker. Even in a bull scenario, with the global economy just firing on all cylinders, the intrinsic value tops out around $650, which is still way below today's market price. So what should an investor pay? Well, that all depends on the kind of return you're aiming for. This analysis targets a 9% average annual return over the long haul. And to hit that goal, if you follow the chart, you'd need to buy a Caterpillar stock at $4,000. And there it is, $480. That's the key number from this whole pricing analysis. So to get that solid 9% return, this suggests you need to see the stock pull back a lot from its current price. This gives you what investors call a margin of safety, and right now, it looks like there isn't much of one.
And all of this brings us to our final section, the verdict. It's time to pull all these threads together, the business quality, the valuation, that strong moat, and those real risks to land on a clear conclusion. You know, these final scores really tell the whole story in a nutshell. The opportunity score is a decent 6.8 out of 10. I mean, it is a great business after all. But look at the risk score. It's right on its heels at 6.5, mostly because of that high price in the debt. And when your opportunity only barely outweighs your risk, well, the investment case just isn't that compelling. And so we arrive at the final verdict, and it's pretty clear. Hold or avoid Caterpillar at its current levels. It's an awesome company to keep on your watch list, but the recommendation is to only think about buying it if the price takes a serious dive.
So what are the big takeaways here? Let's recap. 1. Caterpillar is a top-tier company, but it's forever tied to the boom and bust economic cycle. 2. The stock just looks way overvalued right now compared to what it's actually worth. 3. That high debt and weak cash flow are serious risks you have to consider. And finally, 4. For an investor who wants a solid return, a price down around $480 would be a much, much more attractive entry point.
So that's our deep dive on Caterpillar. It's a fantastic company, no doubt about it, but it's trading at a price that seems to have gotten way ahead of itself. For investors, it really seems to be a waiting game. But now I want to hear from you. What stock should we put under the microscope next? Drop your suggestions in the comments below.